Welcome to the deep dive. Today we have a very specific mission based on the source material you sent over.
We do.
We are building a tactical investment plan. The goal is to deploy $30,000 over the next 8 months.
And not just deploy it, but to hit a 10% annualized return by the end of 2026.
Which is tough because the financial landscape we're looking at is, frankly, completely contradictory.
It's a real high-wire act. I mean, on one hand, you have these incredible bullish drivers. The research calls it the quadruple engine.
The quadruple engine, right?
Yeah, you're talking about synchronized monetary easing, big fiscal spending, AI productivity gains finally hitting earnings, and, continued U.S. economic strength.
And those models are pointing to a huge S&P 500 target, something like 7,400 to 7,800.
Exactly, but then you look at the other side of the ledger.
And that's the wall of worry. The one data point that really jumped out at me was the KPE ratio, the cyclically adjusted price to earnings. It's hovering near 40. To put that in perspective for you, that reading has only happened once before.
Just before the 1999 dot-com implosion. A 40x KPE isn't just a number, it's a screaming warning sign about low future returns. The market is priced for absolute perfection.
So extreme bullishness colliding with, well, generational valuation risk.
Yeah.
When you see that, it tells me the timing of how you invest is everything.
And that's where it gets really interesting. Our 8-month window, Jan through August 2026, maps perfectly onto the weakest period of the presidential cycle.
Year 2, the sophomore slump.
That's it. Historically, you're looking at the lowest average returns, maybe 4.6%. But more importantly, there's an average intra-year drawdown between, say, negative 16% and negative 19%.
Oh, wait, if that volatility is almost a given, why would you risk deploying any capital now? Putting a lump sum in Q1 feels like you're just setting yourself up for maximum pain by summer.
That's the right question to ask, and the answer is that fiscal injection, the OBBBA legislation that was signed in 2025.
The big omnibus spending bill.
Right. It's providing all this demand-side stimulus, things like no tax on tips and overtime, auto loan deductions. It acts as a kind of no recession buffer. It won't stop the volatility, but it should prevent a total collapse.
Okay, so let's unpack this for you. We need to balance the math, which says lump sum investing wins, what, 67 to 70% of the time?
Correct.
We have to balance that with the need to hedge against this 40x valuation and that very likely seasonal drop. So what's the actionable plan here?
The plan from the source material is what we're calling the Hybrid Front-Loaded DCA. It's designed specifically for this scenario.
Hybrid Front-Loaded DCA.
Okay. It hedges the big risks, the valuation, the sophomore slump, while still letting you capture some of that Q1 momentum from the fiscal tailwinds. We can't afford to just sit on the sidelines.
So let's make this actionable for you right now. It's a 50-50 split.
Phase 1 is the lump sum part. You invest $15,000, so 50% immediately. Put it in a low-cost S&P 500 ETF, the ones, VOO, IVV, SPLG.
Got it. So that gets you in the game to capture the short-term momentum.
Exactly. Then comes phase 2, the seasonal hedge.
This is for the other $15,000. You're going to use dollar cost averaging. You commit exactly $8,875 on the 15th of every single month for those 8 months.
From January through August 2026. This part is crucial.
Because when that expected mid-year weakness hits, your fixed investment is buying more shares at a lower price. It lowers your average cost.
Precisely. So by the end of August, you are fully invested right before the historically strong Q4 post-midterm rally kicks in.
So to sum it up for you, this hybrid strategy gives you the best balance of offense and defense for this very unique macro environment. It gets you set up perfectly for that end-of-year surge.
But you have to stay vigilant. There's one critical bear trap you need to monitor.
And that is?
The labor market. Specifically, you need to watch the SOM rule. It's a very reliable recession indicator. If the unemployment rate breaches 4.5%, the rule is almost certainly triggered.
And if that happens?
If that happens, you're likely heading into a full-blown recession. And the whole bullish thesis, the 7,800 S&P target, all of it is invalidated. That's the single number to track above all else.